So I up. Recently, you might have seen a clip of me titled, "I lost huge money on Robinhood," which wound up getting over 11 million views. And I hate to say it, but looking back, that entire clip aged horribly. In fact, watching that has caused me to look back throughout my other financial mishaps to the point where if I could talk about them openly and help one person not make those same mistakes that I made, this video will be 100% worth it. Seriously, in a way, it's cost me about $1 million just to sit here and make this video. So hopefully I could help you avoid the same fate. Oh, and also big thank you to Surfshark VPN for sponsoring this video, but more on that later. Anyway, let's start with my first mistake, and that would be the stock market. Here's the thing. Prior to 2020, I mostly just invested in real estate. But when COVID hit and I saw everything falling 50 to 80%, I believe that that would be a pretty good time to buy into areas like airlines, hotels, restaurants, oil, and so on, thinking that we don't usually get this big of a discount, so I bought in pretty heavy. But to my disbelief, within the first few months, those initial stock picks had increased 50 to 100% in value, and in 2021, I saw Robinhood IPO, and at that time, my thought process was, geez, this seems like a pretty good deal with all the money flowing into the market, so I plunked down about $150,000 at $35 a share, and then shortly afterwards, in 2022, everything came crashing down. So when it hit $20 a share, I bought 2,500 more shares. When it hit $10 a share, I went and bought more shares. But despite me really liking the company, the stock price just kept going down. And by mid-2022, I made the decision to sell all of my individual stocks for the sake of simplifying down into 3 index funds, and that's it. And that also meant that all of my Robinhood stock was sold for about a 50% loss. Yep, in terms of how that's played out, it's now trading for almost $100 a share. And had I just held, I would have been up more than 250%. Even though I've certainly had other stocks do incredibly well, when you balance everything out between all the winners and the losers, I would have been financially better off just buying into index funds, and that's it. Although the next loss is something I never could have predicted, and that would be the Tesla Roadster. In 2022, I made the decision to sell off my Tesla stock at $314 a share to buy a 1 of 26 yellow Tesla Roadster with 27,000 miles on the clock. To me, everything about this transaction just made sense. I could use my Robinhood losses to offset my Tesla profits, use those Tesla profits to buy a Tesla Roadster, and my bet long-term is that the value of the car would outpace the value of the stock. After all, the Tesla Roadster was the first car from Tesla. It popularized the electric vehicle. It's the only car to be floating around in space. There's estimated to be less than 1,500 of these remaining, and yellow is the rarest factory color. So I thought to myself, the Tesla Roadster has to be a future classic car that's going to be worth a ton of money one day, right? Wrong. Within a few months of buying the car, Elon Musk purchased Twitter. He became a little controversial, and all of a sudden, a glut of Tesla Roadsters started flooding the market. I hate to say it, but I've lost, at minimum, $30,000 on this car, and to make matters even worse, I've only driven it 500 miles over 3 years, while also spending over $10,000 in repairs and maintenance to replace some items that have just worn out on the car over time. Needless to say, as a car, it's a blast to drive, but as an investment, unless these one day sell for $250,000 to $500,000, I'm going to take a loss at roughly so far $80 a mile for what I've driven it. But hey, if you're curious how much I would have made putting my money in just about anything other than the car, here you go. Oh, and by the way, since I don't drive this car enough, if you want to make me a serious offer to buy it from me, I'll link to all the information down below in the description. Maybe it's going to be one of those moments where as soon as I sell it, the value is going to skyrocket. With my luck, that's what's going to happen. Anyway, in terms of me losing even more money, and hopefully you not falling into the same mistakes, here's something that will apply to everybody, and that would be paying taxes. In 2014, I started working with a new CPA who seemed pretty diligent and well-priced. Like, she'd help me optimize my income, structure LLCs, tell me different ways that I could save. She handled my taxes. At the very beginning, everything was fine. Although, as I started earning a little bit more money and doing YouTube videos, I started to get the sense that she didn't actually know what she was doing. But until that point, nothing had gone wrong, so I continued. And then 2020 hit. In 2020, she recommended that I get a 6-month extension to give her more time to file my taxes. So I went and asked her, okay, that's totally fine. How much do I have to pay the IRS? To which she said, oh, don't worry, you're all caught up. You're not going to have to pay again until the end of the year. So I trusted her. I just let it be, and I continued on making YouTube videos. Until about 12 months later, when I got a bill from the IRS and the state of California for an $80,000 underpayment penalty in my taxes. Of course, when I confronted her about this, she admitted that she made a mistake. But in order for that mistake to be reversed, I had to go and pay the $80,000. So I did. But when it came time to getting it reversed, a year later, the state of California denied my request because they said an accountant's error was not reasonable cause for not paying my taxes in full at the time it's due, even though I had written evidence of everything. I then filed an appeal, waited another year, and it was also denied. So instead of going after her errors in emissions insurance, I just took the loss on it. I figured it's my mistake for trusting her in the first place, and I switched accountants expecting it not to happen again. Except her mistakes didn't end there. Once I switched accountants, he caught that she didn't file the proper election on my corporation, essentially meaning that I would be double taxed on 2 years' worth of income. Thankfully, we barely made the cutoff for all of that to be reversed and file the proper elections, but my gosh, lesson learned. That's why when it comes to your taxes, don't cheap out. Get the best person you can. Get a second opinion if it's necessary. Make sure you're paid up to date. And if errors do happen, because we're all human, just make sure they're corrected or amended as fast as possible. Although before we go into this next mistake, which is probably one of the most difficult for me to talk about that I've never shared before, it helps to remember that in the big picture, at least I wasn't browsing the internet without a VPN. Like, here's the thing. Anytime you connect to public Wi-Fi, or really anytime you surf the internet, your service provider is able to see which websites you visit, how much data you use, track your location, and potentially even intercept your data and sensitive information if it isn't encrypted. In this case, protecting yourself isn't just from financial mistakes, it's also your personal information and privacy, which is why for the last few years, I've been using today's sponsor, Surfshark VPN. For those unaware, Surfshark VPN works by encrypting your online data to help secure your personal information, mask your IP address, and prevent hackers from identifying your city, country, and download history. Or basically, a VPN is able to swap the real location of your device with a new one, giving you the ability to virtually travel anywhere around the globe. This means if you're out of the country, you could swap your location back home so that everything works normally, or if you're into watching Netflix, there are plenty of shows that are only available in select locations. On top of that, Surfshark's Clean Web feature also blocks ads, trackers, malware, and phishing attempts, allowing you to surf the web safely. Plus, they don't track, store, or monitor what you do online, so there's no connection or activity logs, and you could rest assured that your activity is private. Even better, but they've also just launched Everlink, which improves reliability with fewer VPN connection drags, better protection for your IP address, and no interruptions during server maintenance. That's why I won't make the mistake of not using a VPN anytime I'm online. And if you want to do the same, feel free to go to surfshark.com/Graham and use the code Graham at checkout to get an extra 4 months for free. There's also a 30-day money-back guarantee, so you could give it a shot and see what you think. Again, the link is down below in the description with the code Graham. Thank you so much. And now let's get back to the next mistake, which is losing Bitcoin. Look, I've made well over 1,000 videos on this channel since 2016. And over that time, I've tried almost every single investment platform in existence because 1, I enjoy trying them out, and 2, when I talk about something, it helps to have actually used it myself. But when it comes to cryptocurrency, unfortunately, I've lost way more than I would like to admit. See, for the last 8 years, I've been buying a small amount of Bitcoin and Ethereum on a regular basis, and over time, that grew to like 2 to 3% of my portfolio. At first, I didn't think much of it, but over time, I thought that it would be a good idea to spread it out throughout various exchanges just to be able to see what they were like and see if I enjoyed them. But unfortunately, a few of those exchanges ended up going bankrupt, and in the process, I lost about 3 Bitcoin and just over 50 Ethereum that got frozen. Now, on the bright side, if you could call it that, the price of Bitcoin back then, at that time, was about $20,000. I invested an amount that I was okay risking, and that was only a portion of my Bitcoin and Ethereum. But regardless, when I see the price today and I see how much all of that could have been worth, it stings to know just how easily this all could have been prevented by sticking with the phrase, not your keys, not your coins, which is something I've repeated on the channel for years and willingly chose not to follow because I thought I was playing it safe by spreading out my money throughout various places. Separate from that, this is also the reason why, more recently, I've just stuck to buying a Bitcoin ETF, and that way I don't have to worry about personal custody, I don't have to worry about any security leaks, and if anything happens, I'm blaming BlackRock. Although speaking of things I haven't really talked about before, my next one is the biggest loss that I have taken on something, and that would be a failed business. A few years ago, it just seemed like everyone in the YouTube space was diversifying outside of content. You had Alex Ramosi, Alex Becker, Max Tuning, Nelk, Mr. Beast, Logan Paul. It was everywhere. So I thought, building a business is the way to go. In fact, almost serendipitously, someone reached out at the exact same time that I was thinking about doing this, and we talked it through. The timing seemed right, I liked the concept, and it seemed like a win-win. I could focus my time making YouTube videos, and they would handle all of the back end because I didn't have the time or interest in doing that. At first, all of it seemed great, but over time, I started to get the impression that maybe some things were being rushed. Perhaps we had to adjust our expectations or possibly move a little bit slower. And at that point, I just wanted to take a pause on the whole thing. But I also thought to myself, Graham, you're such a control freak. Why do you have to micromanage everybody? Just delegate and trust the people who you trust. So I let it be. However, not even 6 months later, it became very apparent that both of us had very different expectations from what we wanted and what we expected from the future. So by the time we amicably cut ties, I was out about $250,000, all because I wasn't happy and totally satisfied with the direction it was heading. That one was a very difficult chapter to close, but you know what? I kept my word to the other person. There are zero hard feelings. I blame myself for not being as involved as I should have been, and I did what I thought was best for the future because I didn't want to be tied to something I didn't wholeheartedly believe in and want to stand behind. Ultimately, this taught me that unless you're actively involved in every aspect of the business and see it through 100% from start to finish, it's not worth pursuing. Ever since that point, I've only worked within the opportunities that I'm willing to give 100% of my attention to. But unfortunately, that means it was also too late for some other investments that I made in the past, like with private equity. Now, maybe it's still too early to tell how all of this is going to play out, but so far, angel investing in startup companies has been one of the biggest regrets. Like, here's the thing. In my email, I get about a dozen requests every single month from people wanting me to invest in their businesses, and in the very beginning, a few of those looked very promising, so I figured I'm going to invest in some of these and give it a shot. However, it's important to keep in mind that unlike publicly traded companies, startup investments are completely illiquid. You have no control over how that company is run, and unless they get bought out by a bigger company or they IPO, you're stuck in it whether you like it or not. Well, in the beginning of my private equity journey, I invested in just over a dozen startup companies that I thought had a lot of potential. But looking back, I would have been so much better off just sticking to buy and hold boring index funds. Even worse, I've tried cashing out of a few of these just to be able to take the loss and move on, but I'm locked up. And of the one I could possibly sell, I'd have to take about a 60% loss on it to sell it on the private market, which at that point, I may as well just hang on to it to see what happens. Now, of course, in fairness, this is just the nature of private equity. About 90% of startup businesses fail, and sometimes you only have one home run that makes up for all the other 20 losers. But if I could go back and do it all over again, I would just be sticking with boring, basic index funds. I would be so much better off. I wish I could, but you know what? Lesson learned. Although speaking of investing, there is one last mistake that I want to talk about, and that would be playing it too safe. Yes, I know that sounds a bit counterintuitive now that I've already talked about private equity, cryptocurrencies, starting a business, and buying a Tesla Roadster, but the reality is, all of that is a very small percentage of my overall portfolio, and with the rest of it, I play it extremely safe, to the point where I've held about 25% of my portfolio in treasuries that make anywhere from 4 to 4.5% interest. This meant that when the market fell with tariffs, I could buy in a big chunk of that dip. But it also meant that I'm missing out on growth because I really like having that stability. Like, here's the thing. In my mind, I prepare for a worst case scenario, and then I work backwards from that to make sure I could power through it. For example, I imagine a situation where my income goes to zero. At the same time, the stock market drops 60%. At the same time that all of my rental income goes to zero. At the same time that an earthquake hits Los Angeles and demolishes everything that I own. At the same time that an unexpected bill comes due when I'm experiencing a medical emergency and can't ever find a job ever again. I know it sounds completely stupid, but I feel better knowing that should all of that happen, my family's going to be okay. And keeping about 25% of my portfolio on the sidelines, earning 4.5%, helps me do exactly that. I guess I just put a price on my peace of mind and playing not to lose to the point where I'm okay not optimizing every single dollar if that just helps me feel better and sleep at night. Or maybe that's just me rationalizing how I'm just as emotional as every other investor and why I don't trust myself to do anything other than just buy and hold index funds on a regular basis, and that's it. Anyway, stepping back and looking at the big picture, I realize I'm incredibly fortunate just to have had the chance to take these risks, even if some of them didn't pan out. And the upside is that by sharing what I've learned, hopefully you could avoid the same mistakes that I've made. So if there's one takeaway from everything that I've learned, it's this. Always take a slow, steady, and boring approach to investing. There are no shortcuts. Index funds might make you less money up front, but generally, they'll make you so much more money in the long term. Pay close attention to where your money is going, even if that means you have to hire a professional to give you a second opinion. And make sure you never make the same mistakes twice, which also includes hitting the like button and subscribing if you haven't done that already. Yes, I know, it's annoying when I ask for it, but if you made it to this point in the video, you haven't done that yet, please do. It helps the channel tremendously. And as a thank you for doing that, for anyone who's made it to this point in the video, if you comment down below, I will do my best to read and reply to as many of you as I can. So thanks so much, and until next time.